For a look at the Fed, rates, and more, let's bring in Matt Miskin, co-chief investment strategist at Hancock Investment Management, and Matt Diczok, head of fixed income strategy for the chief investment office at Merrill and Bank of America Private Bank. Good morning to you both. I will use last names as well, of course. Matt Diczok, we were just talking about the market sort of evolving expectations for what the Fed might do. We've seen this backup in market yields and maybe a reduction in the prospect for a rate cut in March. Where do you stand on what the Fed is plotting out this year, what the market should expect?
Yeah, so obviously it's been very interesting. We've seen a Powell pivot here, probably the Powell pivot 3.0 if we're counting, and that's great news. And his flexibility and the FOMC's flexibility is actually a good thing. It feels like you might get whiplash every once in a while trying to follow them, but to change your tack and to change what you're doing when the economy and market demands it makes a ton of sense. So it's clear that they shifted on rate cuts. They weren't talking about them 4 months ago, and then a couple months later, they were talking about them. But importantly now, on the quantitative tightening side, they're making sure that liquidity is not going to be a problem. They told you that in the minutes. They followed up with Dallas Fed President Logan, who had managed that program before, talking about it. Now it's getting more in the mainstream press. So at the end of the day, the Fed will not be a scapegoat for a recession. They want to play for that soft landing. They believe the disinflationary trend is intact. The employment market is not too hot. We have about 170 million people in the labor market. So every 1% move in unemployment is about 1.7 million people out of work. So they're going to play for that soft landing. They've got a chance, and they're going to try to stick that landing. And that is a possible move, and that is the likely base case in our scenario. So that pivot, both on liquidity and rates, is here, and that should hopefully provide a soft floor for risk assets over the near term.
And now, just real quickly, when you say your base case, is it that it begins in March, or just that they have an orientation now that they're looking for the opportunity to ease?
So our belief from Mark Cabana and the team on the Bank of America research side is that they'll officially start to taper QT in March and finish it off finally in June. Again, it seems like they feel very risk averse, and they do not want to be blamed this year particularly for a recession. And so it seems like they're going to err on the side of caution. So an earlier taper and an earlier end is our forecast.
Matt Miskin, how does this filter into your view for all the asset markets, risk assets as well? Because, the economy is sort of still continuing to outperform perhaps expectations when you look at retail sales, you look at the weekly jobless claims. If we can assume that that's the economy we have, maybe you don't need the Fed to go easier. On the other hand, they're very cognizant of some of these late cycle dynamics and the fact that they don't want to be too restrictive.
Yeah, and Steve actually mentioned this morning, too, that, you've backed off some of the pivot party momentum that happened at the end of the year. And really, you've seen a tightening of financial conditions a bit to start this year. We do think that the Fed is unlikely to cut in March. The data looks too strong at this moment. The QT scenario, maybe that is one where they start with the balance sheet. But we go back to earnings. And earnings season for Q4 is not looking particularly strong. The estimates were for 8% earnings growth at the beginning of the quarter. We're coming in at about negative 2%. Well, negative 30% is actually what's been reported, but we're only 10% way through. And 2% is what the analyst community is looking for. Right now, there's just been a huge push forward in terms of looking for that earnings growth. It's almost like a government in terms of what the analyst community is doing and kicking the can. So Q4 of 2024 is expected to see 20% earnings growth, which sounds great, but we think that's actually going to be hard to do. We think there's more optimism, and you really got to lean into the quality factor now, looking for high ROE, good balance sheet companies, because earnings growth slowing, even though that pivot from the Fed helped cause markets to recover and really rally into Q4. We want to be a bit more defensively positioned, looking for good quality companies.
Hey, Matt Diczok, I just want to follow up. What's going on with corporate spreads? In general, it does seem as if that financial conditions have tightened with the Fed rhetoric. But one part of the market where financial conditions have not tightened, corporate spreads have come in. It strikes me that what's happening in part is the corporate market is kind of baking off the default concerns that were linked to recession, but also there's a bit of a reach for yield right now. What's happening in that space right now?
That's a great question, Steve. So we're below 100 again on investment-grade credit spreads. So clearly, the market is noticed and has seen the Fed pivot. So any concerns about default cycle changing are kind of falling to the wayside, as again, it seems like the Fed is very concerned about not being scapegoated for recession. So very interesting that you picked up on that. But again, I want to come back to Matt Miskin's excellent point. That I was fortunate enough last year, we had Howard Marks on a call, which was great. One of his great insights is not first order thinking, but second level thinking. So yes, the Fed is pivoting. Yes, there might be a soft floor, but at the end of the day, the market has internalized a lot of that already. And the market has already priced a lot of that in.
Yeah, and that probably explains a little bit of the sluggish start to some of the markets so far this year. Guys, we have to leave it there. Matt and Matt, appreciate it this morning.
All right, coming up, we have an exclusive interview with Chicago Fed President Austin Goolsbee. We're going to try to find out what he's thinking about the future course of interest rates. That's at 8:30 a.m. Eastern Time. But first, the White House awarding millions of dollars in grants and funding to improve EV charging infrastructure. This story breaking just in the last hour. Phil LeBeau has the details next. Squawk Box coming right back.
The White House wants to give the EV industry a charge in the form of millions of dollars to improve public charging stations and infrastructure. Phil LeBeau joins us now with more on the story. Phil.
Hey, Melissa, this is part of the White House's ongoing push to expand EV adoption. And a big part of that, as we've talked about many times, is the fact that you have a lot of people who, when it comes to buying an EV, say, well, I can't really do anything if I don't drive it, or if I want to drive it long distances because of charging anxiety and the fact that the charging network in this country, it stinks, in the words of many people, the public charging infrastructure. Aside from the Tesla supercharger network, there's a lot to be desired in terms of the public chargers, which is why today the White House is saying that it's taking a number of steps between today and yesterday. Here are those steps. First of all, it's going to be coming out with new charger tax credit rules for those people who want to put a charger in their home. They're also putting $46 million into EV worker training, not just to work on EV batteries, electric vehicles, but also chargers and charging networks. And speaking of public chargers, yesterday the White House said it's going to put $149 million into fixing and upgrading the public chargers. Please, anybody who drives an EV will say, please do that, because the public chargers in this country, wildly inefficient in terms of sometimes you stop and you get one that works. A lot of times you stop and you get one that is either broken, is very slow to charge, and people generally are not happy with the system overall. There are 170,000 public chargers in this country. As you take a look at shares of EVgo and ChargePoint, keep in mind that the Biden administration is pushing to have 500,000 chargers in this country. Look, 500,000 chargers is great. 500,000 chargers ain't great if they aren't working well. So they've got to be up to speed. That's a big hill to climb by the end of 2026. Also, take a look at shares of Tesla and Rivian. The market share for electric vehicles, pure electric vehicles in this country last year was 7.2%. That is expected to get up closer to 9-10% by the end of this year, depending on how demand is. And don't forget, we hear from Tesla with its Q4 results and what they say for guidance for 2024. That will be next week. Guys, back to you.
Yeah, and then the public perception, too, Phil, in terms of the performance in the cold. Just a couple days ago, there were those pictures from Chicago, Tesla graveyard because of the cold. Cold weather isn't a friend for electric vehicles at all in terms of charging and performance.
And that's not a surprise, Melissa. Yeah. That should not be a surprise at all. That's not just electric vehicles. Any battery-operated equipment is going to perform much lower, if struggle to perform at all, in super cold weather. I mean, that should not come as a surprise. I saw these stories and I thought to myself, who told you that a battery would work well when it's -5 outside? That's just the nature of electric vehicles.
Right, but when weakening demand is already there, it doesn't help, that's for sure. Phil, I want to get to some of the headlines that we're seeing crossing on Spirit Airlines. Reuters is reporting that Spirit is pushing JetBlue to appeal that decision that blocked the merger, reportedly urging JetBlue to exhaust its legal options to complete the deal. Sort of underscores, the headlines that we've seen lately in terms of Spirit's options and the limited options that they may have.
And because you said limited options, that's the key thing to focus on, Melissa. They don't have a lot of good choices here. What are their choices? Drop it all together and look at their finances. I mean, we have documented this, and we'll talk more next hour about how quickly they could run out of cash and go either to Chapter 11, and according to Helene Becker at Cowen, amongst others, there's the possibility that they could face liquidation. Now, Spirit is not planning on liquidating. Spirit's best option probably at this point is to say to JetBlue, appeal. If you appeal, we have a shot at least at this coming together. If you're JetBlue, you're also looking at this saying, okay, this Spirit is worth far less than we originally proposed this. And B, we've got shot down with the Northeast Alliance. We got shot down the first time on merging with Spirit. Do we really think it'll succeed on appeal?
All right, Phil, we look forward to your next report next hour. Thank you, Phil LeBeau. Coming up, lawmakers have agreed on a deal to avoid a shutdown, but there are still some big clouds hanging over Capitol Hill, like taxes, massive debt, and the race for the White House. We'll have a panel ready to tackle those issues next. And as we head to break, a look at yesterday's S&P 500 winners and losers.